Financial Yun. My metric number is 10D8020F1037.
Assalamualaikum warahmatullahi wabarakatuh. And hi everyone. My name is Siti Saranabila binti Syahir. My metric number is 10D8020F1009. I'm from D80 2B.
Assalamualaikum warahmatullahi ta'ala wabarakatuh. My name is Raja Ahmad Daniel bin Raja Jaafar. I'm from D80 2B. My matrix number is 10D8020F1041.
Hi everyone. This is a presentation video for Chapter 5 of Financial Accounting. Today our group, Lucky Charm, would like to share about contingent liabilities. As the beginning, I would like to explain the definition of contingent liabilities. Contingent liabilities can be defined as a possible obligation that arises from past events and whose existence will be confirmed only by the occurrence or non-occurrence of one or more uncertain future events not wholly within the control of the entity. Contingent liabilities can also be a present obligation that arises from past events but is not recognized because it is not probably that an outflow of resources embodying economic benefits will require to settle the obligation, or the amount of the obligation cannot be measured with sufficient reliability. That's all for the definition of contingent liabilities. Then I would like to go through the recognition criteria for contingent liabilities. Actually, contingent liabilities are not recognized as a liability on the face of the statement of financial position. Apart from satisfying the definition of liability, the framework has also advised the following recognition criteria to be made before a liability could be shown on the face of the financial statements. For the first one is the outflow of resources embodying economic benefits such as cash from the entity is probably. Secondly is the cost or value of the obligation can be measured reliably. If an obligation meets the definition of a liability but fails to fulfill the recognition criteria, it will automatically classify as a contingent liabilities. Although contingent liabilities is not presented as a liability in the statement of financial position, but is instead disclosed in the notes to the financial statements. Below, I would like to show a diagram of recognition criteria of the contingent liabilities. Alright, I think that's all from me. Now, I would like to pass out to my other group members. Thank you.
I would like to explain about measurement of contingent liabilities. So it can be divided by 5 points. The first point is best estimate. The amount recognized as a provision shall be the best estimate of the expenditure required to settle the present obligation at the end of the reporting period. So the second thing is risk and uncertainties. The risks and uncertainties that inevitably surround many events and circumstances shall be taken into account and reaching the best estimate of a provision. So the third point is present value, where the effect of the time value of money is material. The amount of a provision shall be present value of the expenditure expected to be required to settle the obligation. The fourth is a measurement is future events. Future events that may affect amount required to settle an obligation shall be reflected in the amount of the provision where there is a sufficient objective evidence that they will occur. So the last one is expected disposal of asset. It is gain from the expected disposal of assets shall not be taken into account measuring of a provision. So, the next slide I will explain about accounting treatment of contingent liabilities. Contingent liabilities should not be recognized in the financial statement but may require disclosure because the contingent liabilities are inherently uncertain. They should be assessed continually to identify whether the criteria for recognizing a provision have been met. If this occurs, a provision should be recognized in the period which the criteria are met. This would be represent a change of accounting estimates regarding the likely outcome of an uncertain situation. So, I would like to show you guys a picture of mind map contingency.
The first contingent liabilities is probable liabilities. It is determinable and current based on the contract, agreement and laws. It is measurable with little uncertainty and it can be estimated and it can record on the financial. The second liabilities is possible liabilities. Possible liabilities are uncertain, exact timing or amount unknown, may or not may be recorded in the financial statement. And lastly, may be recorded in notes to the financial. And the third one is remote liabilities. It is improbable or cannot be estimated, do not meet or recognition criteria as a liability, not record as a liabilities on the financial statement, and not record in the notes to be financial. Presentation of contingent liability in financial statement. Contingent liabilities. Liabilities that depend on the outcome of an uncertain event must pass two thresholds before there be reports in the financial statement. First, it must be possible to estimate the value of the contingent liability. If the value can be estimated, the liability must have greater than 50% chance of being realized. Qualifying contingent liability are records as an expenses on the income statement and liability on the balance sheet. If the contingent loss is remote, meaning it has less than 50% chance of occurring, the liability should not be reflected on the balance sheet. Any contingent liabilities that are questionable before their values can be determined should be disclosed in the footnotes to the financial statement. Contingent liability example. The first example is lawsuit. Second is product warranty. The third is pending investigate on the pending cases. The fourth is bank guarantee. The fifth is change of government's policy. The sixth, change in foreign exchange, and the lastly is liquidates damages. Statement of comprehensive income. Firstly, at the revenue, we minus the revenue with the cost of goods sold and we get the gross profit. After that, at the expenses, we plus the salaries expense, administrative expense, warranty expense and utilities expense, and we get the total expenses. After that, we minus the gross profit with the total expense and we get the net income. Statement of financial position. Firstly, at the asset, we have current asset. We plus the cash and account receivable, and we get the total current asset. After that, we have property, plant, and equipment, or also known as non-current asset. We plus the buildings, sport equipment, and we get the total properties, plant, and equipment. After that, we plus the total property, plant, and equipment, which the total current asset, and we get the total asset. And the other side, we have the liabilities. At the current liability, we plus the note payable current, which the account payable, warranty liability, unearned revenue, and we get the total current liability. At the long-term liability, we have notes payable. And lastly, we have stockholder equity. We plus the common stock, retained earning, and we get total stockholder equity. And then lastly, we plus the total current liability, long-term liability, and the total stockholder equity, and we get total liabilities and stockholder equity. The amount of total asset and total liability and stockholder equity must be same.